CF, and I will guiding you through this our learning journey, which would in total last up to 1 hour and a half. So, we would like to let you know that we are recording the webinar, and please notice that materials and presentations will be available on our online cloud, and you will be able to easily download them. Just after we will finish the webinar, all will be online, and you will get all the passwords. We will publish the webinar also on our YouTube account. So let me now briefly provide you some technical details, explanations I believe you are all familiar with, but still. Probably you have seen your name on the list of participants, and a headset symbol shows that you are audio connected, and you will be able to hear a conversation. If you want to, please turn on your camera that we can see you. If you don't want to, it's not a problem. And you do this by clicking on the symbol of the camera. And in order to have better sound quality, everyone will be muted except for the speaker in the given moment. And if you have questions or comments at any time during the presentations, send them in the chat section. You can see it in your right corner in the bottom page. If not, then click on the bubble in the middle of the screen. And please expand the chat button, choose option send to everyone if you want that everybody sees your questions. So with this quick overview of the technical setup, let's move on and see what is on our learning agenda for today. First of all, I will shortly introduce our institution, Center of Excellence in Finance, what we are, what is our mission, and how we realize this mission. And then we are going to listen to our faculty and pay attention to their messages. Representative of the European Commission will do the overview of the European directives on European anti-tax avoidance packages. And then the Dutch experiences with different types of tax intermediaries will be introduced to you. And at the end, we will devote definitely enough of time for questions and answers, so discussion session. I would also like to use this opportunity to thank our partners, Ministry of Finance and Tax at Customs Administration of the Netherlands, Slovenia's Development Corporation, and the Ministry of Finance of Slovenia for supporting us in designing and delivering this learning program. So, warm welcome to the CF again, and let's see what we do. We support capacity development for public officials through learning. That means that we are organizing, designing, and delivering face-to-face events, webinars, as this is one of them, seminars, study visits, conferences, roundtables, and all others learning initiatives. As you can see on the slides, our geographical focus is Southeastern Europe, and we also go beyond. Our focus is our EU member countries, also EU candidate countries. We cover also some EU potential countries and neighborhood countries. So this is good mixture because we are learning from each other, and sharing experiences is one of our aims. And for today's webinar, we have registered more than 30 participants from 11 countries. So our learning community is great. We are having with us officials from tax administrations and offices, international organizations, state tax inspectorates, and some land ministries. So thank you, each of you, for joining us. And I would like to just briefly mention our thematic focuses, as we have now 5 thematic pillars at the CF. In the middle of the picture slide, you can see more technical 3 pillars. These are public financial management, tax policy administration, and central banking. Under PFM, we have budget preparation and execution, accounting, and auditing. Now, today's webinar goes under tax policy and administration, where we cover the most burning questions mostly on tax administration, but we also do have policy issues. And then we have also central banking. But these are more technical pillars, and we very quickly realize that sometimes it's not enough if you want to contribute to effective reform process and you are perfect technical expert, but if you don't know how to convey a message, if you don't know how to delegate your work and support teamwork or do a presentation, you cannot be successful. And we strongly believe that leadership skills, soft skills are of equal importance of technical skills. And that's why we develop this umbrella of leadership for managing reforms. And we address these leadership topics just by providing leadership events on only leadership aspect, but also in tax policy administration, for example, we every year do a combination. Our focus is more leadership, but we are doing this within the tax policy and administration topic. And the last umbrella topic that we recently developed is called data and analysis for designing policies. And this program focuses on activities of econometrics and macroeconomic analysis. With this program, we support our constituency in providing high quality information for policy and decision making, ensuring effective on-the-job application of economic concepts, tools, and models, and carrying out strong analysis to support policy development and decision making. So let's go to today's webinar, and during it we will talk about ways on how to involve tax intermediaries in boosting transparency and preventing cross-border tax planning. And our first speaker, Rafael Saniternik from DG Tax Suit, European Commission, will discuss with you Anti Tax Avoidance Package and its main elements. And then later on, Steven van der Vrande and Dennis ten Hove from Dutch Tax Administration will also talk about their cooperation with different types of tax intermediaries. So, once more, I would like to remind you about asking questions. Please raise your questions whenever you need additional explanation or comments. You can write questions, as I said, in text chat section, and it's your right corner in the bottom of the page. And do not forget it to send it to anyone. So I would like to open the proceeding and give the floor to the first presenter, Rafael. Rafael, thank you for sharing with us your findings, and the floor is yours.
Thank you, Maya, and greetings from Brussels. Now, let me just upload the presentation. Now, it's a bit sunny today, but you never know in Brussels, it might get cloudy shortly. So,
yeah.
So, as Maya said, my name is Rafael Saniternik. I'm a policy officer in Company Taxation Initiative Unit of Taxation and Customs Union Director General, and I'm a seconded national expert from Ireland. From Irish Tax Authority. So, and today I'm going to present Anti Tax Avoidance Package, focusing on Anti Tax Avoidance Directive 1 and 2, also known as 8.1 and 8.2. And just wait for the presentation to load.
Okay, Rafael, I will give you a notice when we can see the presentation. Okay, so when it loads up. And just to tell you, your face is now on the screen for everybody to see.
Oh, great.
Present. Okay. Good. Okay.
Now, can you see it now?
Yeah.
Yes,
we can see it perfectly. Very good. Thank you.
Perfect. Okay, no problem. So, like I said, that's the info page. Now, the anti-avoidance package was proposed by European Commission in January 2016, and it kind of was it was part of ambitious agenda for easier, simpler, and more effective corporate taxation in the EU. We have to remember that BEPS OECD program just published its final report. I think it was October 2015. So this package focused on providing a common consolidated, coordinated response to the BEPS action plan package. So the main part of this presentation will be Anti Tax Avoidance Directive, which form part of the package. There was a separate recommendation on tax treaties, which focused mainly on including principal purpose test and revising definition of a PE. Revised Administrative Cooperation Directive, which proposed country-by-country reporting, which I'll go to next slide. And there was a communication and external strategy, which kind of laid ground for cooperation with third countries, so non-member jurisdictions, and kind of outlined the proposed common EU listing process of non-corporate jurisdictions for tax purposes. There were some other documents as well, published as well, a staff working document and a study on aggressive tax planning, which identified the most common tax planning structures and maybe what to do about them. So this slide is just an overview, summary of iterations of directive administrative cooperation in the field of direct taxation. So as you can see, we are now on the 6th iterations. The latest one, which deals with mandatory disclosure, was for intermediaries, which I believe Stephen and Dennis might touch on later. As you can see, the whole directive or the administrative cooperation focuses on transparency and cooperation between member states, exchange information. It doesn't give any or doesn't provide for any charging rights. It just eases the cooperation between member states in respect of automatic exchange of information, spontaneous, or information on a request. So as you can see, the DAC4, which formed part of the Anti Tax Avoidance Package, was the automatic exchange of country-by-country report, which was in response to BEPS Action 3, I believe. So EU Commission tried to have a common implementation of that action within the EU. Now, so as I mentioned already, Anti-Tax Avoidance Directive 881 and 882. 881 become law, has been agreed in July 2016, and it laid down the rules against tax avoidance practices affecting functioning of the internal market. It differed slightly from the proposal because proposal had 6 distinct measures to fight it, while the agreed directive had only 5. The switchover rule has been dropped. And then 882, which I come at the end to, became operational, become law on 29 May 2017, and amended the 881 directive. So it wasn't a separate directive, it amended the original one and added some rules in respect of hybrid mismatches with third countries, but as well made some changes to hybrid mismatches with EU member states. So now ATAT, as I mentioned already, it was part of the EU response to BEPS action plan and to have a, let's say, non-divergent implementation of those action plans within member states within the EU. It is very much principle-based. It doesn't say exactly what has to be done in each action. It kind of broader outline how to implement certain system, how they're going to implement. Therefore, there is a lot of optionality within ATAT in respect to different measures. And it's a minimum standard, like I said, so member states can go further. They can put further restrictions or further actions against fighting against tax avoidance. So, like I mentioned, the proposal included 6 measures: interest limitation, which was kind of a response to BEPS Action 4, exit taxation, switch over clause and guard, which weren't directly maybe attributable to BEPS actions, but they were still seen as an important step towards fighting tax avoidance and aggressive tax planning. CFC rules, action 3 of action plan, and item which is item 2. Like I said, switchover rule has not made it to the final, it hasn't been agreed, so we only had the 5 measures. Yes, like I mentioned already, several options have been added. The original proposal was a little bit narrower, but during the negotiation process, it was felt that several options are needed in order to properly cater for specifics of member states' national tax framework. And the ATAT had hybrid mismatches rule. I mean, ATAT 1 had a one applied to hybrid mismatches between member states. Now, ATAT 2 added rules in respect of hybrid mismatches with third countries, but as well made small changes to the ATAT 1 rules in that respect. So the ATAT has been adopted by ECOFIN Council, so the Council of Economic and Finance Ministers of EU in July 16, and the implementation for 3 measures of it. It's 1st January 2019, so the interest limitation, CFC, and GAR has to be implemented before 1st January this year. So those 3 measures are operational already in member states, while hybrid mismatches, as amended by the 82, which I go through it, have slightly longer transposition date, and exit taxation is by end of this year. The original ATAT agreement, there was a ECOFIN Council statement requesting Commission to publish rules with hybrid mismatches with third countries. That's why Commission did publish ATAT 2 in October of 2016, which was then subsequently agreed in the Council by Member States and became a law in 2017 of May that year. So, scope. What's the scope of anti-tax avoidance? It applies to corporate taxpayers. So it does not apply to transparent entities or taxpayers that are not subject to corporate tax in one or more member states. Therefore, they might apply to the entities or companies that are established under member state, are resident for tax purposes of member state, and it doesn't have to be established. But as well, if there is a payee in member state, it will apply to that payee, and then the company might be resident in a third country. Now, Article 3 of ATAT defines or lays down directly the minimum standards. So, like I mentioned earlier, it allows member states to go further if they wish to have further restrictions in respect of interest limitation or stronger CFC rules if they wish to. The aim was to kind of increase the average level of protection of internal market of fighting against aggressive tax planning in the EU. Therefore, it is important that member states they have option to go further if they wish to, and the ATAT will even the let's say the widest implementation of the ATAT by member state should still be at least of the standards set by OECD recommendations. So let's go to first substantial provision interest limitation. In generally, as in member states, the interest costs are generally deductible, and what the ATAT is not giving extra deductibility if national legislation doesn't provide it. It actually only limits deductibilities. So, so the interest that we're talking about, or interest expense, had to be firstly allowable under member states' legislation to fall under this article. And the problem which this article is trying to address is that multinational and enterprises, some of them, not all of them, obviously, tend to shift the debt to low tax jurisdictions, and let's say establishing a treasury center within such a low tax jurisdiction, and then they grant loans to at inflated terms to other group members, and let's say the income would be taxed at low rate in the low tax jurisdiction, and the entities based in other member states high tax jurisdiction would be granted deduction for such a interest payment, which it's obviously something not which erodes a base of those member states. Therefore, BEPS report introduced or suggested approach for limiting deductibility of net interest expense. So we call it in ATAT exceeding borrowing costs, which is excess of interest expenses over interest income for an entity or group, which we'll go in shortly. Now, so the underlying principle, as I already mentioned, that financial costs can only be fully deductible insofar as company receives financial revenues. Otherwise, you have to look at exceeding borrowing costs, and you limit it for a company, for a taxpayer, as a 30% of EBITDA. So it's earning before interest, tax, depreciation, and amortization. It's called tax-adjusted EBITDA actually in the directive. There is an option for member states to apply safe harbor provision of 3 million, which will say, and if the amount is less than 3 million, taxpayer can fully deduct it. Some member states went further and provide a safe harbor of 2 million or less. So, like I said earlier, there's a lot of optionality within ATAT. And there's a concept of tax group that the member states can apply the interest limitation provisions based on consolidated tax group for tax purposes. So a group remitter will be subject to those limits rather than the individual company. Now, safe harbor already mentioned. There's as well waiver and option for member states to exclude standalone companies that they're not part of consolidated group of financial purposes, or have no PEs in other member states from the scope of this article if they wish to. And there's an optional as well waiver for long-term loans for public benefit infrastructure located in the EU, and as a whole they have to be located in the EU, and the interest from such loans can be excluded if member states chooses to implement that option. And there's a further optionality, so-called escape clauses, which will, in a consolidated group, financial statements group, if inequity escape clause, if let's say the company itself has a higher equity to assets ratio than the general group ratio, then it could fully deduct its interest net interest expense. And there's as well a group ratio, which I'm not going to maybe discuss, but there are two options which member states could implement if they wish to. And there's exclusion of financial undertakings as well optional. I think the rationale was that the discussions are not fully yet developed in respect of the financial sector. Therefore, it might be detrimental to apply it to at this stage to that sector. But I think the intention is to have some targeted rules maybe in the future. Maybe it's coming from different parts of EU law. And there is an optional grandfathering clause as well, which member state can implement if they wish to, for loans that have been concluded before 17 June 2016, I believe. They can be excluded from this scope, but there can be no further modification of such loans if they remain to be excluded. There is a derogation, as I mentioned earlier, this this provision article is supposed to be implemented by 1st January this year. However, if member states have already rules that are equally effective and they make application to the EU Commission and they're accepted, they can have derogation to the at latest to 1st January 2024 not to implement this article. And I believe 5 countries, EU countries, have been granted such derogation. I think it's Greece, France, Spain, Slovakia, and Slovenia, as far as I am aware of. Exit taxation, Article 5. The objective was to prevent the risk where the assets are moved from a jurisdiction from presently high tax jurisdiction to a low tax jurisdiction, and then they're sold in the other jurisdiction. So this article applies only to transfer of assets or tax residents out of jurisdiction, but it doesn't apply if there's disposal of assets on the transfer, because obviously if there's disposal of assets, there's a realization of the gain, and presumably national law would capture the market value and make adjustment if such a disposal is not at arm's length or market value principle. So the transfer that I covered are assets from head office in one member state to PE, so it doesn't have to be between 2 companies, it can be within the companies. It can be transferred out of EU in total, or it can be transferred the whole business of a PE to different member states of a third country. And tax residence as well is covered within the exit tax provision if you transfer it to member state of a third country. Exception is if their assets are left behind in the PE and tax residence is transferred. Now, in order to comply with the EU case law, there's a deferral which member states have to implement, that if transfer of that comes with an exit taxation is within EU EEA, then taxpayers have to be given the option to arranging the payment of a 5-year period. And as a prevention of double taxation, the member states that the transfers or tax residence is moving to have to accept the valuation of the assets for the purposes of their taxation as agreed by the first state. And there are some exemptions to financial assets. If there's a temporary up to 12 months transfer of assets, financial assets, and they are due to revert to original state, they can be excluded from the scope of exit taxation. Now, general anti-abuse rule. A lot of member states already have, well, all of them have targeted rules in respect of anti-avoidance, but some of them have already quite developed general anti-abuse rules. Now, this one is just to kind of plug the holes or kind of catch all. So if there's no targeted rule in place, this article would kick in and say that when there's application of non-genuine arrangements, so there's no commercial rationale behind arrangement, then the member state can deny tax benefit accruing to otherwise to a taxpayer. Now, this general anti-abuse does not say that it will be applied in all circumstances, because the taxpayers still have the choice to make the most efficient structure if it's for commercial reasons or commercial affairs. Now, CFC rules, so controlled foreign company rules, and the aim would be to discourage shifting large amounts of profits from highly taxed member states to a low tax jurisdiction. And often the schemes would involve mobile passive income, such as royalties coming from intellectual property within a group. Now, and the overall purpose of the CFC from company perspective would be to reduce the tax burden. So what the article says is that there has to be participation, so ownership threshold of 50% or more, direct or indirect, in the subsidiary located in the low tax jurisdiction. and have to be a low level of taxation in a third country or member state as well. And the low level taxation is defined as a effective corporate tax rate lower than 50% of the effective corporate tax of the member state of the taxpayer. So you see here that you can have even CFC within the EU, and it's worth remembering as well that CFC doesn't have to be subsidiaries or standalone companies. They can be PEs as well. So if a company has a PE in other member states, it will be treated as CFC under Article 7. And the ATAT provides for two options, option Roman 1 and Roman 2. I call it options A and B. And they're quite different approaches how to decide what's a CFC and how to compute the income and reattribution of income. Option 1 is more prescriptive. It gives categories of such so-called tainted income, and it's like interest, royalties, dividends, disposal of shares, financial leasing, insurance, banking, and so on. And while the option 2, it gives more kind of principle when the income is artificially diverted to a subsidiary, and they can be different classes of income as I go into the next slides. So member state may opt between option 1 or 2. I think at least 10 member states opted for each option, so the split was more even rather than one option is much more preferred than others. Now the option 1 or the option A, like I said, the list of incomes already discussed, and now there is an escape clause as well that if the CFC or the subsidiary of the PE carries a substantial economy via third countries, there's no obligation to apply the escape clause. And as well, there's options for member states, so-called throw-out clause. So a member state may give option may opt not to treat as a PE or entity if not more than 1/3 of the income falls within categories listed, and financial undertakings are not more than 1/3 of their income through transactions with associates. Under policy option 2, it reattributes the income to member states generated from assets raised which are effectively managed through a significant people function in the parent member states or in the parent company. And the amounts treated beyond harm's length are treated wholly artificial. There are exemptions available for member states for low accounting profits, so accounting profits less than 750,000, with the non-trading profit of 75,000 and low profit margin, which is less than 10%, I believe. Now, ATAT 2. So, like I mentioned already, the ATAT 2 has been proposed in October 2016, following from the ECOFIN Council statement requesting for such a provision on hybrid mismatches to address issues from OECD report. So the original ATAT covered only mismatches between member states, while now we have covered with third countries and as well involving branches. And there is some option to exclude regulated capital instruments in the financial sector to end of 2022, I believe. So the ATAT 2 or the hybrid mismatches have to be implemented by end of this year and be operational by January 2020, apart from reverse hybrids, which is 2 years later. So they have to be operational by 1st January 2022. So just briefly, maybe I'm not going to go into much detail there, but generally hybrid mismatch, it's a situation involving corporate taxpayer and involves as a difference in classification of an entity or a transaction between 2 or more jurisdictions, member states or third countries. And it can result in a deduction without inclusion or a double deduction. What does mean here that either 2 countries, 2 entities claim a deduction for a payment, or deductions claimed by one jurisdiction is not included as an income in other jurisdiction. Now, there's some other categories as well covered by data too, as imported mismatches and hybrid transfers. But let's say I'm going to go just to briefly to show an example what is meant by hybrid mismatches and double deduction, and how to neutralize it, how the directive proposes to neutralize it. So in this situation here, we have three companies, A, B, and C. They're all associated. Company A is resident in member state 1 or state 1, and B and C are resident in state 2. Now, entity B is a hybrid entity. It's seen as a non-transparent from perspective of state 2, and seen as a transparent from member state 1. And entity B makes a payment, interest payments to an unrelated party. And now, from member state 2 or state 2, on the group regime, interest of B and income of C, because C has some unrelated income. On the group regime of state 2, they're set off against each other, and there is no tax on those on the income of C, and therefore deduction is taken for the payment. And from perspective of state 1, B is seen as transparent, therefore income is attributable to A, and A takes deduction as well for the payment made. Therefore, the situation of double deduction. So what the data says, the primary rule that member state of investor jurisdiction, so A, will deny the deduction. And if, let's say, A is the state 1 investor is not within the EU, so there is no A tax to implement it, then there's a secondary rule, member state of the payer jurisdiction will deny the deduction. And maybe just, I know I'm running a little bit time-wise, so there's another example of neutralizing deduction, no inclusion, but I think I might just skip it maybe. It's similar. Well, it's not similar enough, but it just shows the mechanics of the provisions, and it will be available to look at after. So just a brief summary of the measures in respect of anti-tax avoidance directives. As you can see, there are 5 measures still, and just a short summary of what they are: interest limitation, exit agar, CFC, and anti-hybrid rules. And thank you for your attention, and hopefully you didn't fall asleep. And that's my address if you have any questions, but hopefully if there are any, I can answer at the end of the webinar.
Thank you, Rafael, for sharing us this informative presentation. I would like to encourage, if anybody has a question, just raise it. You can write it in the chat box. You can ask it now directly to Rafael.
Okay, I would just like to add, if you want to speak, please just unmute your microphone if you have any questions.
So far, we don't see any questions. Okay, then I will suggest to go further. And in this respect, I would like to invite Dennis and Stefan from the Tax and Custom Administration from the Netherlands to share their experiences with different types of intermediaries and their work. Thank you again, Rafael, and welcome, Dennis and Stefan.
Okay, I think we can hear them.
Good morning, everyone, from the beautiful Utrecht in the Netherlands. Stephen and I would like to talk to you about the role of the tax advisor in the Dutch perspective. So maybe it's good to tell a little bit more about what we do at the Dutch Tax and Customs Administration. I'm a technical coordinator, so I'm responsible for the quality of our tax audits we are performing, and also to have the overview of the process of the audits we are doing. So from the selection of audits to the performing, and also the things that go beyond that. My colleague Steven is performing tax audits at large businesses within the neighborhood of Arnhem, so like the middle of Netherlands, if I'm correct.
That's correct. Yeah.
Before we go to our presentation, I would like to have some opinions. We have two propositions for you. I hope David can get the first one on the screen.
Okay, it is the audit evidence of tax advisor isn't of any use to our tax audit. And I will open the poll now, and everybody can click on an option. It's agree or disagree. We'll have 2 minutes to do this, or 1.5 minutes. So it's a short poll. You will see it on your screen, and just click on it. Okay, 3, 2, 1. Here we go. Okay, you should be able to see the question now.
Yeah, we can see the question, so please answer them.
Yes, take your time. I am interested about your feelings about this.
Okay, we have one answer disagree, one answer agree. That's really good.
50-50?
Yeah, now we have 2 on agree. Good, good. Let's give it some more time. So we have 3 people answering. Now we have again 50-50. It's 2 against 2.
Please give your honest opinion. That would be really amazing.
Okay. Disagree, 4 against 2 that agree. So we have 13% disagreeing and 7% agreeing and still waiting. Okay. It's like a handball match, like our goals are coming in. It's 4 against 4 now. It's like a sports event.
Who is going to win today? Yes.
Yeah, who is winning?
Tax administration.
Yeah. So we have agree 6 people and disagree 5 people. There's 40 seconds left, so you can still put your answers in. 7 agree and 5 disagree. So it is mixed. Okay, let's leave it again for it's 20 seconds to go. So if you have an opinion, just click on the answer. Otherwise, we're still at 7 that agree and 5 that disagree, and 10 seconds left. So it's 9, 8. The last chance. And the poll is over. So we had 7 people that agree and 5 people that disagreed. Okay, so yeah, that is the first one. Let's see poll results. Do you see the results now?
Yes.
Okay.
Yes, we see them.
Okay.
I will come back to this one in our presentation we're going to have.
Okay,
and also going to talk with you about our thinking models of how to use the knowledge and the capacities of the tax advisor in a good way. And of course also in a less good way. Thank you so much. I have a second question for everyone. And that's also about tax service providers, our tax intermediaries. We have a vision about it, but I'm also really interested in your vision. So here it comes. Individual account management of tax service providers increases compliance and decreases compliance deficits. You can choose about 2 options again, agree and disagree. And I think we do 2 minutes again, David.
Yeah,
or?
it is 2 minutes. You should be able to see it now.
We see it.
Okay, perfect. I will just quickly repeat the question also. So individual account management of tax services providers increases compliance and decreases compliance deficits. Okay, so please choose your answer again. So we have 2 people that agree and 0 that disagree for now. Let's see. 3 agree with the statement and again 0. So good. Oh, we now have 5 people that agree. Good. And another minute to go. 6, 7 people, 8 people agree. Still 9 people agree. So we're in full agreement so far. Okay, 12. Yeah, good. Let's say another 30 seconds for you to choose the answer. And then 12 people have answered and all of them agree. 13 agree. That's the lucky number. Let's say 10 more seconds for everybody to click. If you're still thinking about it, you can click now. Otherwise, I will close the poll in 10 seconds. Okay, 5, 4, it's long seconds, 3, we still have 2 people wondering what is okay, we have 15 now. Okay, good. So I will close the poll now, and I will show you the results. So we had 15 people answering, and all of them said that they agree with this statement. So it was 15 against 0. Okay, back to you.
Thank you. David, can you give me the right to send the presentation?
Of course, I will give you the presenter's rights right now. So it is PPT, right? You have the extra computer?
Yes.
Yeah, good. Change role to presenter. Here we go. Okay. Okay, we can see that something is happening.
Yeah, it's all fine.
Okay, we can see the presentation, and the word is all yours. Yeah.
Please.
Thank you for your help with the poll, David.
Of course.
It gives us an insight about how our audience is thinking about the role of the tax advisor. And from our perspective, we think a tax advisor can be useful in a lot of ways with our audits, but also before that. Let me tell you about what we're going to discuss, and I hope I can put the next sheet on. Here it comes. This is our content for the next 20 minutes or so. We first want to share our enforcement palette with you. Which kind of enforcement measures do we have, and how is the intensity of it? And before that, I begin with some strategic starting points, because that gives you perspective of how we want to look at our enforcement. Then Stephen will take you on the vision, on the supervision of large businesses, but also on small and medium enterprises. And we would like to give you some examples there also. And please ask any questions when they are coming up. When we've done that, I think it's good to also tell you our audit approach. In the Netherlands, we have audit approach that we share externally. So tax advisors have them, our taxpayers have them, so they know how we want to audit and how to perform it. We're going to talk with you about 2 models. The first model is the transaction model. That's more like which phases do you have, and in which phase what's the role of the tax advisor in each phase. And we have a really important model, that's the layer model. And that is how we use the work that has been performed by external parties within our audits to be quicker and more efficient. So that's what we're going to do today. Looking at our strategy, the NTCA has the strategy that starts with trust, and the presumption is trust. We want to approve as quickly as possible the tax returns, but it has to be possible. So it's not a blind trust, it's justified. And justified means that we know what we're doing and that we have a certain knowledge about it. And this strategy is not only for audits, it's within the whole NTCA. It's a wide perspective that we have. Our attitude when we're performing audits and also when we are talking with tax advisors, external parties, is open, transparent. We tell what our points, what our issues are, and we are discussing that in an open and honest way. But we're also looking, always, we are looking at the most important thing in our strategy, and that is compliance. And compliance we measure on 4 ways. The first one is, of course, the registration of a taxpayer. The second one is the filing of the tax returns. The third one is the correctness and the completeness of the tax return. And the last one is the payment. So when a taxpayer does all the 4 things correctly, then we know it's a compliant customer, and then we are really happy. For us, compliance is number 1 and revenue is second. Because when when a taxpayer is compliant, the revenue comes itself, and that's important for us. When we look at enforcement, we do it responsively. So it's like action, reaction. And we do that also with procedural justice. That means that we give enough time to give a response to questions. We give a lot of opportunities to taxpayers and also to tax advisors to think problems through and get with a correct solution with each other. And in our communication, we do that respectfully. So we try to imagine what the circumstances are of a taxpayer, and we also talk about that, and also with the advisor. And for us, it's also always so that equality goes before the law. I think this gives a perspective of how we think and how we want to work within the MTCA. And we do that within the opportunity that you have to go to enforcement. This is our enforcement palette. And we can be very hard and very soft. And you see here at the beginning very light intensity, and that begins with reducing risks. Reducing the risk of non-compliance by education, by service, and also by completed tax returns. We share information we have about the customer to also the tax advisor, for example, the bank accounts and the numbers that are at the end of the year. We share that knowledge with the tax advisor when he's busy with making the tax return, so that we are sure that we have the right numbers and that the information that we have, that it is pre-completed. So, of course, always check it. We have a pre-completed tax return ready. For particulars is that, so for individuals. When we go a step further, we do communication strategy. For example, a certain sector, we look at the sector, and when we see problems or deficits on possible non-compliance, we send a letter, and with that we hope that they go further with that. Also, we cooperate with other agencies, and we have horizontal monitoring. Horizontal monitoring we will discuss later on, but it is an important measure that we want to cooperate with our taxpayers, their tax advisors, and also their accountants. And the cooperation means that we want to know the customer, and we go in conversation. We want to look at documents to be as quickly as possible at the customer before the filing is taken care of, and solve possible deficits. Also, we do on real-time approaches. We contact by phone, we do visits, and also we do real-time checks. When we look at this orange color, our national color, you can also think about our tax audits at the real-time approaches. So we go to the customer and we audit the tax returns, but it can also be done by desk. So our colleagues are looking over the tax returns, and they ask some questions by letter or by phone or whatever is most convenient. And then we have, of course, the last one, that is repressive measures. When there is no voluntary compliance, then we go do our audits, and also, when it's needed, the criminal investigation. You see here all the options we have to go over to enforcement and also to have a good role for the tax advisor. So let's make it a little bit more concrete, and let's start give the word to Stephen, who wants to talk with you about some practical experiences.
Before I'm going to tell you something about evasion and supervision, I will explain more about the two different categories of organizations we have in the Netherlands. We have made this distinction because we are treating the two groups differently. The first group we have, we call it large businesses. I mentioned it as follow. We have Dutch listed entities in that group. That's because of their stock market sensitivity. It's a complicated factor that often requires speed and carefulness of their NTCA. We also have municipalities and provinces. These organizations are categorized in this group because of their specific fiscal issues. Also, companies with a turnover of 10 million euros and more, and total wages of 10 million of 2 million euros or more are listed to this group. Most of the non-profit organizations with a wage sum of more than 8 million are also listed. And there are some specific companies who are listed because of a decision of the NTCA. That's because of the politically and publicly sensitive. All the other companies we mentioned as small and medium entities. Our vision and supervision is that we try to influence the behavior of businesses in such a way that they comply with the tax laws and regulations in a structural manner. For example, for large companies, we have an approach that's called horizontal monitoring. Dennis told about it. It's an approach for business that want to cooperate with the NTCA and who are able to maintain or improve the quality of their tax returns themselves. And they get also help from the tax advisor. For large business companies, we implement the client coordinator. A client coordinator is an employee of the NTCA who is the first contact person for the company and his tax advisor. He talks with the responsible persons of the company regularly. In that way, the client coordinator collects a lot of information about the company and the persons who are working there. Every year, the client coordinator will discuss the gathered information with the colleagues involved. Together, they set up a strategic treatment plan for the specific company. In this treatment plan, we describe which supervisory measures will be implemented in the coming year. This ensures that we implement the right supervisory measures for that company. We share the strategic plan also with the company. The objective is to create a treatment that's right for the company. So every company deserves the treatment they deserve. We also have for small and medium entities, we don't have a client coordinator. That's because of the amount of companies. There are much more small and medium entities than we have than large companies in the Netherlands.
Yes, when we look at the numbers, I think around 10,000 companies are large, and we have around 1.8 till 2 million companies that are within the SME. So the small and medium entities are in numbers way bigger, but when we look at revenue, they are less, of course.
Heb je tot 11 uur? Of,
ja, we hebben hem tot 12 geboekt.
Ja, 12 uur. Ja, maar we zijn even in de webinar. Dus.
Yes.
For the small and medium companies, we have a specific form of horizontal monitoring. It's called horizontal monitoring via the tax service provider. Most of the small and medium companies make use of a tax service provider. The NTCA will conduct an independent research into the quality assurance system of the specific tax service provider. If the quality of the tax service provider is approved, we close a compliance agreement with the tax service provider. The tax service provider has to select some clients who are suitable for participation, and the tax service provider can register them. The tax service provider files the tax returns every year or every period they prepare for the specific clients. We assume that the tax returns are correct. If a tax service provider has doubts about a specific issue in the tax reform of a tax return, he can ask for a preliminary consultation. This is the same as for large businesses. So we can discuss it before he sends the tax return to us. We have a few acceptations when a tax service provider sends us the tax return. If we look at the tax return and we have unacceptable tax issues, we are going to discuss it. There are also randomly selected audits on specific tax returns. Every year, we're monitoring the function of the compliance agreement with a specific tax service provider. On that way, where we learn from each other and we make it better.
Yes, maybe good to have one quick moment on that perspective. When we look at SMEs, this is a way of involving the tax advisor right at the start, what you show here, but also give them a way larger role than that they have normally, because we make also agreements of how they are going to do their work and what we expect of the documentation and also about the audit programs they implement, so that we have more certainty that the tax returns are correct and are complete, and that's really important. But not every SME has a tax advisor which has an agreement with the NTCA. We also have clients that just regularly do their tax return and want to do that on a good way. And also there we want to cooperate with the tax advisor, but then it's not with agreement of horizontal monitoring, but then it's just the law we use. And also then we always want to make use of the work that has been done by tax advisor. So on both cases, we want to see his documentation, his files, and also what he did. So we can use that in our audits. And I will come back on it later when I would like to discuss with you the layer model, because Stephen is going to you to the right from the start moment.
Yes. As the quote in this sheet describes, it's all about working together. We eliminate issues, or the tax provider eliminates issues, and we talk about it in an early phase. In that way, we can reduce the risks and discussion points in advantage. Let's see how it works. Yeah. Now I'm going to talk about the focus on what is behind the tax return. As NTCA, we try to talk about fiscal issues and risks in an early phase. We prefer to discuss fiscal issues before the company submits the tax return. If we discuss the fiscal issues and risk before submitting the tax return, both parties have clarity about the accuracy of the tax return in advance. So we don't have to audit that specific tax return anymore. This saves time and
Compliance.
yeah, it's also good for the compliance. There are some advantages. I describe them over here. We have no duplication of work done by others. Dennis will tell you a lot more about it. No fact finding in the past, because you talk about an issue at real time and not after a few years. The company and also the NTCA have certainty about the tax position of a company, and there's a reduction of the administrative burden. We save valuable time, and the company is certain about the tax return at an early stage, and that's important. This means more efficiency for the NTCA and the tax service provider. Now Dennis is going to tell you more about the models we have at the NTCA.
Yes. We talked about our small and medium enterprises and also large. We have an audit approach that is suitable for every company that's being audited by us. It's called the CAP, Controle Aanpak Belastingdienst, some Dutch words today also for you, and it's translated like the audit approach of the NTCA. It's also translated in English, and it's published externally. So when you look at this item on our corporate site or using Google, you can find it easily, and you can read more in depth how we think about our audit approach, but also how we are really doing it within our audits. So as I've said, this audit approach for all audits, all enterprises, and we are also here really transparent on our approaches to our public and to our taxpayers. The three models. Workflow model, I'm not going to discuss this right now because we don't have the time for it, and it tells you much more about which activities do we do in which phase of each tax audit. The transaction model, that's an important one because then you have a really clear role of the tax intermediaries and the tax advisors, because they are really a big part of how processes are being run at companies, but especially on the documentation of it and of how you can use that during the audit and get more certainty about it. The last model we discussed today is the layer model. That's het schillenmodel in Dutch. And the layer model is about the cooperation with tax intermediaries and advisors, but also cooperations with others like accountants or other government cooperation. Okay, the transaction model. What we want to have in our tax returns are the transactions that are being done in the real world. So when a customer or a company is buying a product or a service, we want that transaction ultimately comes in the tax return. And therefore, there are a lot of records, primary, subsidiary, sometimes a lot of notes that's being made, and we want that to come in our system, and that the correct amount of tax is being paid. That can be VAT, that can be corporate tax, that can be corporate tax, whatever. So in the real world there are transactions, and that has to be covered by data and a lot of systems. A lot of IT comes in perspective. And you see here that from the data the business process gets to run. There is logistic, financial, personals, but also a lot of estimates. And the estimates are made by the company itself, but the tax advisor also looks at getting the best tax position for its clients. So when you look at estimates, there's also always a tendency to choose the best position to have the lowest amount of tax. He has to do that within the boundaries of the law, and the tax advisor knows that. The role of the tax advisor in the transaction model is mostly huge when it comes to the clarity and the documentation of all the processes, so that we can use that in our audit. We also have the general ledger, and we can use that electronically. We have appointments with software suppliers, so that we can easily have the complete general ledger with just a few mouse clicks away. This is the transaction model in headlines. More important for now is the layer model. You can see here that audit evidence does not need to be obtained solely from the audit test carried out by us, by the NTCA, this our Customs Tax Administration. We want to use information of other parties and also use information that's there with the tax intermediary. This is the layer model. Take time to look at it for some time. In the core, you see the business, and with the business, we mean all activities that's being performed, all the business processes, all the documentation, all the knowledge, and all the things that the company is doing. The company has to register the activities and has to have the clear invoices, the logistic documents in place, the inventory, the timesheets, a lot of things a business has to do. And to have that set, they have to have some internal control. So they have some checks themselves. They have some separation of duties, of course. And that internal control gives certainty about the risk that being there. And that can be business risk, but it can also be fiscal risks. So the first layer is the internal control we can rely on, and it reduces risks. The second one you can see here in the simplified layer model is the external audit. There you can find the tax intermediaries, because the tax intermediaries advise, but they also check. They also do some audit field work, and therefore they rely on the internal control of a business. So they check if that's being performed correctly. But they also have to do their own work to come to the tax return and to file it correctly. So complete and accurate. So that reduces risks a lot. What we always do when we're performing an audit, we have, of course, a starting meeting to get to know each other, to know more about activities, but we also talk and discuss the processes and the business processes and who is doing which part of the bookkeeping and the advisory. So we have also a conversation with the tax advisor, and in a lot of cases we also look at his complete file for making and producing the tax return. You see here that that's not the only thing, because we miss two spots, and that are the spots of the tax audit. We rely on the business, the internal control, and the external audit. So that's the part of discussing and talking with the tax advisor and inspecting his documentation and his story, what he's done. And when we do that, when we rely on the business, internal control, and external audit, we have to do ourselves less work. So we are lazy, and we want to be lazy because when that work is performed correctly, we can focus on the fiscal risks that's being left over in the tax audit. And therefore you see a small thing on the left, and that's our tax audit. We always want to do some own work, and that can be substantive testing, but it can also be on specific areas we want to audit. So the tax advisor can help us a lot when we look at doing the audit itself. That is, I think, the layer model, or you can also look at it as an onion model. Practical experiences. Can we add some? Of course we can.
Yeah, we can. Then we have to talk about if you perform an audit in the meeting session, you talk also with the tax advisor. What work has he done, and you're going to the tax advisor to watch the files you can find over there. So you get a lot of information from the work from the tax advisor or the accountant, or and then that's great for our position, and then we have to do less work.
I think that's true. Yeah. We used almost 30 minutes, so I go to the final sheet, and we're getting ready for your questions. So thank you for your attention, and please let us know any questions you have.
Thank you, Dennis and Steven, for this very comprehensive presentation. And now it's up to you, dear participants. Do you have any questions for them, or maybe to Rafael? We are here to discuss. We are coming from different countries. Do you have any kind of similar or different approach? Any kind of experiences? Share it with us. Yeah? Just, if you have the questions, please unmute yourself and go directly to our presenters, or write it in the chat box. We'll wait a bit. Maybe for the meantime, any kind of questions from Rafael to Dennis and Steven, or back? No? You're coming from two completely different perspectives, but still okay. Maybe there is something that you want to share among you, or just ask one to another? No. No.
It's quiet. I see. It can be that it's clear, or.
Any of our participants?
Let's give it a minute, right?
Yeah.
Good. And see if
we are
we
still
have any
here.
questions.
We will not run away.
We will not run away.
Yeah,
Okay.
and if you want to know something else about how we're performing audits or how we're selecting audits, any question is welcome. So please feel comfortable about it.
Yeah. And maybe just sharing with us, in your country, does this exist that you put into account the knowledge of tax intermediaries, you cooperate with them, or no? Is this possible or doesn't exist? This is all very much interesting, and we'd like to hear your story. No?
Yeah, the presentations were too good. So
I think so.
now our participants understand everything.
They are available
It's
also
great.
for some related questions, of course. If you think that this is not relevant, if there are so many other related topics, you can ask them. No?
And vice versa, if our presenters have any questions for the audience, you can also ask.
Yeah.
We saw that's had a effect.
Yeah, you know who is our audience, so go for it if you have it.
Yes. Well, when we look at our way of cooperation with tax advisors, tax intermediaries, we do that on a trust base, and we have most of the time a really good relationship with the tax advisors. And the tax advisors also know that it's important to work with us and to establish that relationship. Is that the same in the country that you are doing your tax audits? Can you give me your perspective on that? It's a broad question for everyone.
Okay. If you can, maybe you can just write it shortly in the chat box and people can read it. To send it to everyone, just maybe in a short sentence, and let's see if we have any. Okay, Maya, I'll be back in a minute. Okay, I'll be right back.
Yeah. Okay, we don't have any questions. Rafal, anything?
Do you?
Yeah, go,
Rafael,
Dennis, please.
Do you have any suggestions or topics you would like to discuss?
Oh, we cannot hear you.
Okay.
Could you please unmute Rafal? We cannot hear him.
Hello?
Yeah, okay.
Yeah, he's here. He's here.
Yeah, okay.
Okay.
No, I was just going to say that I was available to discuss, Anti Tax Avoidance Directive. Anybody had any issues or questions around it?
How do you think our perspective of working together with tax intermediaries match with your story?
Well, it's always good to get information or a cooperation with tax intermediaries. So there's obviously DAX coming around on the road. I'm not sure.
Is it for you common that you work on an equally base with a tax advisor?
Well, I personally, I wouldn't work maybe in a close operation with tax advisors, but I mean, in Ireland, I know that audits are, where I come from, Irish tax administration, there's a cooperative compliance framework where large multinational companies cooperate with tax administration, and tax advisors takes part in it. So obviously more cooperation is always useful, I would say, and your poll shows that as well, that we believe that a greater cooperation or information from tax advisor would decrease the compliance gap. So hopefully other jurisdictions will follow the same way.
Yeah, and I think you're correct that within large businesses, it's more important and it has more value. And within SMEs, from my perspective, I think it's harder, but it's really a great opportunity to enhance the relationship. So I think we're on the same page there. But it can be a challenge because it's also about how you are willing and able to do that. For example, as a tax auditor, mostly you get tax audits where you have high fiscal risks and you find mistakes. And then it's the question how you deal with that together. And it's better than to help each other out than to fight over and over.
Mm-hmm.
Oh, of course. But depends on the severity of mistakes as well, obviously, and was it deliberate or was it genuine mistakes and so forth. And obviously, there's aggressive tax planning and tax avoidance schemes. Who comes up with it? It's not the tax administration. So I mean, if you work with some,
true.
So I mean, there are tax advisors and there are other tax advisors. So obviously
Yeah.
there has to be a bit of common sense there behind corporations.
Definitely, because also some tax advisors, they advise very aggressively, and then you cannot cooperate with them. Then you have to fight with them, of course. But most of the tax advisors I deal with are within the white or the gray section, and they not want to make large mistakes. But sometimes it happens because rules are really hard to follow.
Yes. Like I say, I think 99% of companies in tax advisor are probably genuine, hardworking, and want to follow the letter of the law. But there's just other 1% or just
Totally
need to
agree.
be mindful of it. Yeah. So
Totally agree.
Okay. Great.
Any questions coming in, Maya?
Any questions? We haven't received any.
No, I haven't received any either.
But I believe and I hope that you all benefited from these two presentations and a nice chat just recently. And before we really say goodbye, David, could you please give me presenter's rights to
Right away.
show you the final slide?
Here you go.
Okay. Mm. Do you see it?
Yeah, we can say just move
Okay,
on.
so
What's next?
yeah, we are approaching to the end of today's webinar, and I would like to extend my gratitude to the speakers and to you participants. I would also like to thank our online learning and the event management team for supporting the webinar. We will not be able to do this without David and without our Ivana, who helped us in between and before in advance. And I would like to invite you to join us at the Center of Excellence in Finance for our next learning events in this year and in next year, and you can see what will go on in the November this year, and then in beginning of next year. You are very welcome to follow us on our social media, to check our website, and you can see also my email address and our website address, and you can come to me anytime. I'll be happy to answer all your questions. And thank you again. I would like to stress again that all the materials will be sent to you, the link to the materials, and I would also like to ask you to submit a short survey after the webinar, because we always want to know what was okay, what functioned well, what didn't function, and we'd like to be better next time. Thank you again for commitment and your time and efforts, Rafal, Dennis, and Stephen. And thank you for joining us, to all of you from around Europe. I hope to meet you virtually or in person in the future. Thank you and all the best. Bye-bye.
thank
Bye.
you.
Bye bye.
Kunnen we eruit?
Ja.
Okay, thank you all for joining. We are now closing the webinar room. So have a nice afternoon and greetings from the rainy Ljubljana. Okay, I'm just telling Maya that we are now closing the webinar room and extending greetings from rainy Ljubljana. Good. Yeah. Okay.